Welcome back to the Investor Professor Podcast. This is Dr. Ryan Peckham, and this is episode 33, Plant Your Tree. And on today's episode, we're going to talk about your investment philosophy. We're going to look at the earnings that have come out. We're going to talk about how crazy this January has been and kind of what your thought process should be when you see the numbers bouncing around as much as they've been doing. But we're really going to talk about the earnings of Apple, Microsoft, some of our top names, some of the companies that have fallen pretty hard, and kind of what our perspective needs to be on that. So I'm excited for today. I'm very excited about today's episode. A lot of good stuff to talk about, a lot of good gold for you to really think about when you're thinking about constructing your portfolio. So I hope you'll join me today. Let's get to work. Well, welcome back to the show, everybody. I've been excited to do this episode all week. Been thinking about what I'm going to talk about. You know, you're looking at all these negative headlines. It's one of those months where we start comparing, you know, how bad it is to the other times it was really bad, right? So you start seeing headlines, worst month since March 2020, worst start to the year since 2008. Worst January ever. I mean, you're just seeing all these negative headlines. And so, you know, you have to separate your emotions from your intellect and think about the long term, or let's take a deep breath. Got a lot of good stuff to cover today. But one of the things I wanted to make sure to point out is, you know, a quote that Warren Buffett used to say, which is someone's sitting in the shade today because someone planted a tree a long time ago. So someone's sitting in the shade today because someone planted a tree a long time ago. And that's why today's episode is Plant Your Tree, right? This is the time when you have to start looking at your portfolio or the stocks that you want to get in. And you need to look at, okay, did I add more shares of my favorite companies this month? And we're going to cover some of the earnings. We're right in the middle of earnings season. We had Microsoft and Apple this past week. We also, next week, we're going to have Google and Amazon, and we'll figure out how they do. And we'll talk about some of the companies that have been really beat up. And we'll talk about some of the companies that have not been beat up. Because when you look at it, when you look at this, you know, this drop that we've had in the market, it's not even, you know, it's not across the board. Not every single company is getting beat up like all the others, right? In March of 2020, every company was getting killed, but not today. That's not happening today. So we got to talk about what's the difference between the companies that are getting beat up versus the ones that are not, because it's going to be very important for you when you start looking at companies and you start doing your own research of what kind of companies could be the ones that are going to do better as we have rising inflation. So let's go ahead and get that disclosure out of the way. I'm not your financial advisor. This podcast is for entertainment purposes only, and past performance is not indicative of future results. So before you think about investing, talk with your financial advisor, do your research, and then act accordingly. So when you look at what's going on in the market, and we've talked about it the last couple of weeks, is when you have rising inflation. You know, I told you that rising inflation means that a company's future profits are not worth as much today, because you're discounting them back to today, if you remember kind of time value of money. So companies that make a lot of money currently, right now, that money that they're making right now is going to be worth more. So you're basically seeing a lot of the coronavirus pandemic 2020 trades being unwound and put into safer places, bigger companies that are going to be able to handle inflation a little bit easier than smaller companies. They have more options. They have more cash on their balance sheet. They're going to be kind of a safe haven, right? So you're looking at kind of the boring, you know, dividend-based stocks that are holding up well. And we'll talk about that. So, you look at a company like Peloton, right? So Peloton a year ago was $154, and now it's $25 a share. So 154 down to 25, not a great place to be. But when you look at it, Peloton doesn't have positive earnings, right? It was kind of everybody was investing in them because Peloton was selling a lot of bikes because people were in their homes. Now that, everything is kind of subdued, people want out of their homes, they're going to gyms, they're doing whatever, but they're not on their Pelotons as much. And so that has impacted the stock. Even if you look at Robinhood, we're a year past all the meme mania, all the meme stocks. It's been a year since that happened. Robinhood at their high was $85 a share. They're currently down to $12.73. So they have not become profitable yet either. And so when you look at companies that have had serious drawdowns in their stock price, many of them are companies that are not profitable. They do not have earnings yet. Now, some of them are on the path to profitability, but the market is no longer rewarding them for just having good sales, right? So they're going to have to figure out a way to be profitable. Now, if you look at companies that have held up well this month, you look at Coca-Cola, and you look a month ago on December 29th, Coca-Cola was $58.75, and now it's $60.84. So in a month of craziness, when everything's getting repriced, S&P 500's down almost, I think, 7-8%, NASDAQ's down 15%, whatever it is, Coca-Cola is actually up, right? So these safer names, these safer stocks are holding up well in a tough market. And so you have to think about that. You have to think about, not everything in your portfolio can be a growth stock. You need some safe stocks, right? We've talked about risk. We've talked about right-sizing your risk. And it's okay to have some risky companies, but you also need some safe names as well. And these are the ones that are going to help you power through because like Coca-Cola pays a dividend of 2.76%. And those kind of companies are starting to become more attractive. Now, everybody's kind of been worried about, these companies that are reporting earnings, how are their earnings looking, all that kind of stuff. So one of the things I want to do is I want to look at some companies and let's dive into their earnings. So first company I want to look at is Apple. Now, I gotta say that if whoever you compare to Apple as far as earnings is concerned is probably not going to look that good. So Apple reported earnings on Thursday, and it was an unbelievable quarter. Just absolutely unbelievable. I'm going to read some numbers to you here. Hopefully I don't lose you. But Apple did almost $124 billion in revenue, right? Remember, revenue is sales. And they were expected to do $119 billion. Their earnings per share were $2.10 versus $1.90 or $1.90. Their iPhone, they sold 71.6 billion versus 67.7 billion, which is what was expected. They beat every single category: iPhone, the Mac, wearable services. The only thing that they missed on was the iPad, which was from supply chain issues. So the fact that we've been hearing all these supply chain issues and the only thing that impacted Apple was on the iPad is pretty remarkable. So Apple's cash now stands at $202 billion. You heard that correctly, $202 billion worth of cash. They have, so far to date, they have spent $467 billion since 2012 buying their own shares back. So they also pay a dividend. But when we talk about how can a company reward shareholders, most of us, we think about a dividend, of course. But why would a company spend money buying their own shares back? It's the other way that they can reward shareholders. Well, when a company pays you a dividend, if you don't own it in a tax-deferred account, like let's just say it's in your normal brokerage account, you have to pay taxes on those dividends. But when a company buys back its own shares, it's a way of, taking shares off the table, which theoretically should work as it increases the share price. but you don't have to pay any taxes on that. So Apple's taking about 3 to 4% of their shares off the table every single year, meaning that every share that they have, it makes the earnings per share more valuable because there's less shares, right? So, currently have $202 billion in cash, and they've spent $467 billion buying back their own shares. I believe last year they spent $85 billion just last year repurchasing shares, and they spent $14.5 billion on dividends. So when you think about all the bad things that are going on in the world and all the things you could be concerned about on why you shouldn't invest, and then you look at a companies like Apple, when you look at that kind of report, my question is, how could you not be invested in Apple? Or how could you not be trying to invest in Apple? It's just a tremendous, tremendous business. It's almost like their product, right? Their iPhone, the watches, everything. I mean, it's almost like it's not even a product anymore. It's like an extension of your body. How connected we are to our phones. And so you look at that kind of quarter and you look at, and that should tell you, man, if there's any more weakness in the market, if there's any more weakness in Apple, I'm going to be looking to buy shares. I'm going to be looking for, like, is there change in my couch cushion? Can I skip a couple meals to be able to buy into this company, because there's still a long runway ahead of them. And you have to think about all the kids every year with their parents buy them iPhones. They start getting connected on the iPhone. And, you have to own companies. You have to invest in companies for a lot of years, right? Invest in companies for a lot of years. And then when you have a month like the month we're having, you're not nervous. You're trying to buy more, right? You're trying to buy more of that kind of company. So, if you think about all the things that have gone wrong with America, with whatever, over the past, 20, 30, 10, even 10 years, all the bad things that have happened, there's a lot of folks who, unfortunately, they focus on the short-term problems and they miss the bigger picture of how well American companies do over the long term. So you can't let short-term issues derail you from investing. So, I think a week ago, we discussed that we're seeing inflation numbers that we haven't had since 1982. And what the news media doesn't normally tell you, at least I haven't seen it, is that currently our unemployment rate's around 4%. And in 1982, unemployment rate was 10%. But anyways, there's a lot of bad news stories that were happening in 1982. And I went back and looked at just, Coca-Cola. What could you have bought Coca-Cola for in 1982? Right? And so adjusting for splits, everything like that, you could have invested it in 1982. You could have bought Coca-Cola for 65 cents. And now it's $60. So there's a lot of bad things that happened in the 80s, 90s, 2000s, 2010s. There'll be some bad stuff happen in the 2020s. It's the way that it goes, but the overall trajectory is going to be up. So these are the kind of stories that you need to think about when you're seeing all the negative headlines on the stock market dropping and all of that. Most of the listeners of this podcast are younger. You should be happy that the market's down. You should be happy that you get into some names at a cheaper price, right? Whether you're 20, 30, 40, 50, whatever it is, you should be, you should be looking to buy into or buy more of your favorite names. That should be your mindset. So another business I want to highlight is Microsoft. And Microsoft made big news. If you haven't heard, Microsoft is going to acquire Activision Blizzard, or they're trying to acquire Activision Blizzard, the video game maker that does Call of Duty, Candy Crush, World of Warcraft, a lot of these games that have players continuously play them. They're looking to acquire them for, I think it's $69 billion in cash. So Microsoft's like, we're just going to write a check for that. So that's saying something right there where they can just do that for cash. But you look at Microsoft's quarter, and they crossed $50 billion in revenue for the first time. And they're growing, doing well, hitting 20% margins. It's just amazing how well Microsoft is doing. And if you look at, the acquisition of Activision Blizzard, which It still has to be approved and things like that. But if it happens, think about how Microsoft's going to be able to tie that into the Xbox. They have Azure, which is their cloud business. They're going to be able to house all those games on their own cloud. They're going to be able to stream those to gamers, right? And so when you look at Microsoft, and if this goes through, you look at how that's going to impact them 3 years from now, 5 years from now. I mean, it's just another company that's doing very well, that if you can get it, lower than you would like, man, you should go for it. They got great management team. Everything's looking pretty good for them, right? So it's another example where everybody's worried about earnings going into it. Microsoft reports good numbers. They have good guidance, which guidance is how are they thinking things are going to be 3 months from now, right? And so they have good guidance. They say, hey, the market's strong. We look to have a good first quarter of this next year, and show the market, hey, things aren't as bad as you might think they are. I talked about them a bit earlier, but let's go look at Robinhood's earnings. So Robinhood had a loss per share of 49 cents. They were expected to have a loss, but it was expected to be 42 cents. Their revenue or sales were $362 million. They were expected to have $370 million. So that's another, miss. Their crypto revenue, right? Crypto revenue was $48 million. It was expected to be $55 million. So that was a big miss. And then probably the most concerning thing is that their monthly active users, people who trade on Robinhood, was supposed to be 19.9 million, basically, almost 20 million. And it was actually 17.3. And that's a big deal for investors because, their users ballooned during the pandemic when people were staying home, had some money to trade, all that kind of stuff. So now that the pandemic is starting to ease and people are going back to work, they're not seeing as many users on their platform, which is going to be a major problem because that's where their revenue is going to come from. They need people to trade on that site. And if they're losing users, that is going to be a problem. And so this is kind of the same story for Netflix. So when you look at Netflix's earnings, they got absolutely hammered. So Netflix reported earnings on January 20th. The stock was $5.08 at the time. And then after they reported, they dropped to $385 a share. So they dropped $100 a share. And it was the same kind of deal where they didn't add as many users as people thought they were going to, as they thought they were going to. Is the growth of Netflix peaking? Are there any other people around the world that are going to sign up for Netflix? Netflix has a lot of users. They're going to be able to raise their price, which they already announced. But analysts are looking at, okay, well, how much longer how many more times can they raise their price when you have all these other streaming competitors? And a lot of those streaming competitors, Amazon, Apple, some of these other companies that have have very deep wallets that can really compete against them. How long are they going to be able to do that? So, those are kind of the companies that are going to get beat up when you see their reports, if they don't have as many users or that kind of thing. So that's going to be kind of the theme that we have to look for in the coming weeks when other companies report, is seeing, okay, was this a one company anomaly, or is it something that's going to impact every single company? So I have a story I want to share with you. And that is, I have a friend who sold out of the market in March of 2020 when everything was going down, but it was pretty much after it had gone down. And they never got back in, right? They never got back into the market. They missed kind of the upside that we've had since March of 2020. And they keep telling me, hey, the next time the market drops, I'm going to get back in. And so I call him this week and I said, hey, have you started investing again? And he said, no, I haven't yet. I don't know, man. It doesn't look that good out there. I don't know if I'm going to do it. I don't know if I'm going to do it right now. I said, hey, you said you've been waiting for the drop to happen. You've been waiting for some weakness in the market to be able to get back in. It's here. You got to, this is exactly what you said you were going to do. Oh, I know, but man, I'm just waiting to see if it gets a little bit better before I put money in. And so I think that is one of the main ways that people sabotage their own financial independence is that, you say you're going to do it, market gets bad, then you don't take advantage of it. And one of the things you have to understand is that if you have some cash that you want to put into the market, you don't have to do it all at once. Let's say you want to buy AT&T, Coca-Cola, Lockheed Martin, whoever. It doesn't even matter. The name of the company does not even matter. Who are you interested in buying? Right? Well, think about how much money you want to put into that company. $1,000, $10,000, $100,000, whatever it is, and break that up into thirds or quarters, right? And buy a third of what you ultimately want to have in that company. Or if you just want to buy one share, wherever you're at, you have to think about, okay, I'm going to buy one share this month. The next month, I'm going to buy another share or 5 shares or whatever. If you have a lump sum, you can say, okay, I'm going to put a third of it in right now. I'm going to wait 4 weeks, do another third, or however you want to do it. But you do not have to do all or nothing. If you put it all in and it goes up tomorrow, then that's just luck. But it could easily go down, right? So go from being a hero to a zero pretty quick. So look at what you want your portfolio to look at and look at the ones you want to add. If there's some of them that have been beat up more than others, if they have good earnings, if it's a good company, if, their balance sheet looks good, then add to those companies. But you got to be aware of that. So I had somebody bring up a question. They said that I talk about right-sizing the risk. How do I usually do it? Well, normally this is how I do it. If I want to enter into a risky company, I usually put about 2% of my portfolio into that name, around 2%. If it's a company I like, but that I want to be invested in, that's more of a solid company, then I'll put their weighting around 5%. And then if it's a company I love, one of my top companies, that I consider kind of my A group, I get that up to 10%. And I even have some companies that are above that. So, maybe my top 3 are definitely going to be above that 10%. But, if you want to dip your toe in, 2% is normally a pretty good place to be, or to get the weighting, because if you have less than 2%, it really doesn't matter if it even, if it goes up 10 times, it's not going to impact you that much. So you got to do enough to where you're going to feel it if it does well, but if it does poorly, it's not going to hurt you and you can recover from that. So, and really, as we do this, it's all about, your number one way that's going to drive your portfolio is your personal ability to make some money so that you have extra money to put into the stock market, right? So, the person who's in control of 1 times in your income, 2 times, 3 times is you. And that's why we talk about so much about working on your mental, mental discipline, physical discipline, and then investing discipline, right? They all feed off of each other. Being mentally disciplined so that you can be better at your career, your business, so that you can earn more, being physically disciplined so that you're physically able to do those things. It all goes together, right? That's why we're trying to do lessons on all of these facets of your life. So, don't be scared out there. Do not be scared to invest in some of these companies that you've been watching that have come down. As long as they're real companies, they have real earnings, and you believe in their future. Man, my voice is having trouble. I just got done running before I recorded this. So, but really look at the companies that you're looking at. As long as they're good, solid companies and you believe in the long-term value of those companies, do not be afraid. Everything you watch on TV is going to tell you to be scared, to be careful. And you do need to do that, but you also, if you're looking out 3 years, 5 years, 10 years, right? If you have a long time horizon or a longer time horizon, and you're willing to wait and you're willing to put a little bit more into the companies you pick, I would be under the assumption that you're going to do well, right? It's time in the market, not timing the market. So patience pays off. Patience pays off. So with that, I hope you have a great week. I appreciate your time, and have a great week, everybody.